Imagine planting a tree. The earlier you plant it, the bigger it grows. Investing works the same way. The earlier you start, the more time your money has to grow. Today, we'll break down why starting to invest in stocks early can completely change your financial future, even if you start small. Let's say two people invest. The first starts at age 20, investing $200 a month for 10 years, then stops at 30. The second waits until 35 to start, investing $200 a month until 65. Who ends up with more? The early investor. Thanks to compound interest, the early investor ends up with more money, even though they invested less overall. Why? Because their money had more time to grow. Compounding means your earnings generate more ownings. It's growth on growth. Albert Einstein called it the eighth wonder of the world. Here's a simple example. If you invest $100 and it grows 5% per year, next year you have $105. In the second year, that 5% applies not just to the original $100, but to $105, giving you $110.25. By year 3, it's $115.76, and it keeps snowballing. Over decades, this snowball effect turns small, consistent investments into something incredible. That's the magic of time, and it's why starting in your 20s is such a huge advantage. Now let's talk about stocks and one of their secret weapons, dividends. When you own shares of strong, established companies, they often pay you a small portion of profits, called a dividend. These might seem small, like $1 or $2 per share, but here's the key. If you reinvest those dividends instead of spending them, you can buy more shares. More shares mean more dividends next time, and that creates a feedback loop of growth, even if the stock price doesn't skyrocket. DRIP, Dividend Reinvestment Plans. This reinvestment process is often automated through something called a DRIP, Dividend Reinvestment Plan. With a DRIP, every time you earn dividends, they automatically buy more shares, no action needed. Over years and decades, those reinvested dividends can make up a massive portion of your total returns. For example, if you invested in the S&P 500 decades ago and reinvested all dividends, your wealth could have been more than double compared to just taking the cash out. Of course, it's not all smooth sailing. Let's be honest about both sides. Upsides, compounding and DRIP can multiply your wealth over time. You can start small. Even $10 a week counts. You build discipline, patience, and a long-term mindset. Downsides, the stock market can be volatile. Prices go up and down. If you panic sell during dips, we can lose money. It takes time. Real growth happens over decades, not days. But remember, historically, markets have always trended upward in the long run, rewarding patient investors. Starting early isn't about timing the market, it's about time in the market. Even small, consistent steps matter. By starting in your 20s or 30s, you give compounding the decades it needs to work its magic. Eventually, you'll have a portfolio that grows for you, dividends flowing in, reinvested automatically, and your wealth expanding even while you sleep. So don't wait for the right moment. The best time to invest was yesterday. The second best time is today. Start small, stay consistent, reinvest your dividends, and let time and compounding do the heavy lifting. Because the earlier you start, the bigger your financial tree will grow.